Like imagine a scenario where uh, a Wall Street trading algorithm
Right.
just instantly allocates like $50 million into a specific stock.
Oh, wow.
And it didn't make this move based on a long-term market trend or, a sudden shift in consumer behavior.
Yeah.
It executed the trade because an autonomous AI agent was tasked with reading an incoming corporate earnings report.
Okay.
And that agent confidently hallucinated the numbers.
Just completely made them up.
Yeah. It saw a massive profit where there was actually a deficit.
Oh, man.
Because if you look at the news lately, we are constantly being told that autonomous AI agents are packing up their virtual briefcases and, getting ready to take over complex white-collar high-stakes jobs.
Oh, yeah, absolutely.
Wall Street analysts are positioned as the ultimate use case for this technology.
Right. That's the big pitch right now.
Yeah. The narrative is that these AI models can digest the entire stock market, crunch the numbers, and spit out perfect investment strategies while human analysts are still waiting for their morning coffee.
Exactly. I mean, the marketing from the major AI labs heavily promotes this concept of autonomous reasoning.
Right.
The pitch is that we are at the point of deploying these agents into the wild, to make unassisted financial decisions.
Which sounds amazing.
It does, but in a landscape saturated with corporate press releases and just massive information overload, we have to look past the marketing claims.
We really do.
We need rigorous empirical testing to see the actual mechanics of these models when the safety wheels come off.
And that is the mission for today's deep dive. We are unpacking a highly revealing, brand new research paper from Vels AI and Stanford University.
Yeah, the finance agent benchmark.
Right, the finance agent benchmark.
Right.
Our goal today is to look at the hard data and find out if large language models, which is the architecture powering this whole revolution,
Right.
if they're actually ready to autonomously handle real-world financial research.
Exactly.
We are going to see if the technological reality actually matches the current hype cycle.
Well, to understand the significance of this specific benchmark, we really need to first demystify the daily reality of the finance sector.
Right.
Because people often visualize financial analysis as these dramatic moments, traders shouting on the floor.
Right, making split-second bets on a surging stock.
Exactly, like in the movies.
Yeah.
But the actual day-to-day grind is tedious.
Very tedious.
The researchers highlight a statistic that anchors this entire study. Entry-level finance professionals, like the junior analysts at these major firms,
Yeah.
they spend up to 40% of their entire work week just gathering data.
Wait, 40%?
40%.
That is wild.
That time is not spent analyzing the data or building financial models. It is spent purely on extraction.
Okay, let's unpack this because 40% of a high-paid analyst's week acting as a digital scavenger is a massive inefficiency.
It really is.
Think about trying to build a massive, complex Lego set, one of the sets with thousands of pieces. But instead of the pieces being neatly sorted into numbered bags, someone has scattered them across your entire house.
Oh, gosh.
They are under the couch cushions, mixed in with the dog toys, buried in the yard.
Good luck finding them.
Exactly.
Yeah.
You spend Monday through Wednesday just trying to find the specific red 2x4 bricks.
Right, yeah.
You can't even begin to snap the pieces together and build the actual model until Thursday.
Yeah, you are describing a massive expenditure of cognitive energy on retrieval rather than synthesis.
Exactly.
The underlying promise of the autonomous AI agent is that it operates as the ultimate peace finder.
Right.
You instruct it to find the specific red brick, or, in a real-world scenario, the specific revenue derived from a company's cloud computing division over a 3-year period.
Adjusted for currency fluctuations, yeah.
Right, and the agent simply hands it to you. That is the proposed value proposition.
Which would be incredible.
It would. But this raises an important question, though. If we outsource this foundational peace-finding to an AI, what is the downstream effect when the AI confidently hands us a blue brick but insists it is red?
The blast radius of that mistake is huge. I mean, we aren't just dealing with a delayed Lego build here.
No, not at all. The financial domain operates on a scale where minute errors compound rapidly. Global foreign exchange turnover averages $7.5 trillion daily.
$7.5 trillion. That is insane.
Every single day. And markets move based on highly nuanced interpretations of incredibly dense financial text.
Right.
If an AI agent is tasked with summarizing a company's SEC filings, it has to parse complex tables, heavy footnotes, heavily caveated paragraphs.
And legal jargon.
Tons of it. So if the AI's natural language processing stumbles on a double negative or misinterprets a footnote about a one-time tax penalty,
Oh, I see where this is going.
yeah, it might falsely identify that the company has had a consistent earnings beat over 4 consecutive quarters.
So it effectively hallucinates a positive financial trend out of thin air.
Exactly.
And if a human analyst makes a careless mistake like that, there are usually layers of review, right? Like a senior analyst or a portfolio manager checking the work.
Right. There are safety nets.
But the whole point of these autonomous agents is that they operate independently.
Yeah, that's the autonomous part.
So if an agent feeds that hallucinated trend directly into an algorithmic trading system, it could trigger a cascading series of multi-million-dollar allocations based on absolute fiction.
Precisely. And because the cost of failure is catastrophic, the Stanford and Val's AI researchers couldn't evaluate these models using standard vocabulary tests
Right.
or basic reading comprehension benchmarks. They had to build a cheat-proof adversarial exam.
A real torture test.
Yeah. They collaborated with 7 domain experts. These are professionals with extensive experience at bulge bracket banks like Goldman Sachs and JP Morgan.
As well as hedge funds and private equity firms, right?
Yes, individuals whose entire careers revolve around dissecting this specific type of data.
So those experts wrote 537 real-world questions spanning 9 different financial categories.
Right.
We are talking about everything from basic quantitative retrieval to highly complex financial modeling and market analysis.
It's very comprehensive.
But what makes the exam design brilliant to me is the temporal boundary they instituted.
Oh, that's crucial.
Yeah. The questions were engineered so they could only be answered using public SEC EDGAR filings,
Right.
which is the massive government database where U.S. public companies have to submit their financials.
Right.
But specifically, filings published from 2024 onward.
Yeah, that time restriction is the most critical component of the methodology.
Why is that?
Well, large language models are pre-trained on vast swaths of the internet. If you prompt a model with a financial question from 2021,
Okay.
you aren't testing its ability to conduct research. You are testing its memory.
Oh, I see.
It might simply regurgitate a highly upvoted Reddit thread or a Bloomberg article it absorbed during its training phase.
Right, because it's already seen the answer online.
Exactly. By strictly limiting the source material to 2024 and newer, they eliminate data contamination.
Got it.
The AI is forced to act as an active agent, retrieving new, unseen information on the fly rather than functioning as a static encyclopedia.
But that creates a massive logistical bottleneck for the researchers, doesn't it?
How do you mean?
Well, you have 537 complex, multi-step financial analyses, and you're running them through dozens of different AI models. Human graders would take months to evaluate all of that.
Oh, absolutely.
So the researchers used an LLM as judge approach. They deployed a top-tiered language model to evaluate and grade the answers generated by the test taker models.
Yes, they did.
I have to push back on the fundamental logic of that setup, though.
Okay, let's hear it.
We are establishing that these models are prone to hallucination and lack reliable reasoning. Why are we trusting an AI to grade the exam?
That's a fair point.
Because financial analysis isn't a simple true or false quiz. It's highly nuanced. Doesn't using an AI judge just invite a scenario where the test taker writes a really eloquent, structurally perfect essay that contains the wrong numbers?
Yeah.
And the AI judge just gives it an A for good grammar?
Your skepticism hits on a known vulnerability called the holistic grading trap.
Holistic grading trap.
Yeah. When researchers simply ask an AI judge, is this essay correct? The judge relies on its language modeling weights.
Right.
It inherently favors well-structured, confident, flowery text, even if the underlying facts are compromised.
Yeah, it sounds smart, so it must be right.
Exactly. So to bypass this, the researchers completely stripped holistic evaluation out of the system.
Oh, really?
They engineered a rigid binary rubric. The judge AI wasn't allowed to assess the overall quality or tone of the answer.
Okay.
The human expert's ground truth answers were dismantled into isolated pass-fail checkpoints.
So they turned a complex analytical essay into a sterile checklist.
Yeah.
Let's look at how that actually functions with one of the specific questions from the BITS benchmark. The researchers asked the models, How has Carvana's gross profit per unit changed from 2019 to 2024?
Right.
If you ask a human analyst that question, they are going to write a paragraph detailing the raw numbers, the compound annual growth rate, and a narrative about the business drivers behind those numbers.
Exactly.
But the rubric takes that narrative and fragments it into 5 independent criteria that the Judge AI has to verify line by line.
Yeah, so the Judge AI executes a search query against the generated text for each specific fact.
Okay.
Check 1. Does the text explicitly state the 2019 gross profit per unit was $2,852?
Right.
Check 2. Does it state the 2024 figure was $7,196?
Check.
Check 3. Is the compound annual growth rate correctly identified as 20.3%?
Okay.
Check 4. Does the text attribute this growth to operating and technology efficiencies? And check 5. Does it mention new products, specifically calling out origination fees from financing?
Wow, so the model can write a Pulitzer-worthy essay about Carvana's business model, but if it forgets to calculate the 20.3% CAGR, it fails that specific check then.
It fails the check.
Yeah.
And the researchers added a final punitive layer, a strict contradiction check.
What does that do?
Well, after verifying the required facts, the Judge AI scans the entire output to ensure no conflicting or hallucinatory information was introduced.
Oh, I see.
If a model successfully hits all 5 data points about Carvana's profit margins, but arbitrarily adds a sentence claiming Carvana recently acquired a fleet of cargo ships.
Which they obviously didn't.
Right. The entire answer is flagged as a failure.
Wow.
This mechanism directly neutralizes the false positive problem, where models try to hedge their bets by outputting massive walls of text hoping the correct answer is buried inside.
That is brilliant. Okay, so now that we have this unbreakable rubric, we need to look at how the AIs actually take the test.
Yeah, the fun part.
Because they aren't just sitting in a vacuum answering prompts. The researchers placed them in an agentic harness.
Right.
This means the models were equipped with a specialized virtual tool belt to interact with the external world.
Yeah.
They were given a Google Web Search tool, a dedicated API to search the SEC EDGAR database, an HTML parser, and an information retriever.
And understanding the mechanics of how an AI uses these tools is crucial, because an AI doesn't have hands, it doesn't move a mouse or click a browser icon.
Right.
When we say an AI uses a tool, we mean the model generates a specific string of code, usually a JSON object,
Okay.
that triggers an external Python script.
Got it.
For example, the model outputs code saying, search EDGAR for ticker symbol CVNA year 2024.
And then the external script runs the search, pulls the data, and feeds the raw text back into the AI's context window.
Exactly.
Yeah.
And the HTML parser tool is particularly vital because corporate websites and financial filings are filled with complex formatting, images, and embedded tables.
Oh yeah, those filings are a mess to read.
Yeah, they are. The parser strips away the visual layer and translates the document object model into raw, readable text that the neural network can actually process.
It is the equivalent of giving a college student an open book, open internet exam.
Yes.
The catch is that having access to a massive library doesn't mean you know how to use the Dewey Decimal System.
No, it doesn't.
The AI has to actively decide when a question requires a broad Google search versus a hyper-specific SEC database query.
Right.
It has to know how to parse the HTML, and then it has to synthesize the text it extracts.
What's fascinating here is observing the behavioral psychology of these different state-of-the-art models when they're dropped into the exact same agentic harness. Yeah. Because they are operating autonomously, you see distinct strategic differences in how they attempt to solve the same problem.
It's crazy.
Behavioral logs reveal wildly different approaches to tool utilization.
Yeah, reading through the logs, they genuinely develop distinct personas.
They really do.
Like Claude 3.7 Sonnet behaves like a highly methodical researcher. You can call it the persistent explorer.
That's a good name for it.
The logs show Claude making a tool call, reading the return data, realizing the data is incomplete, and then modifying its next search query based on that new context.
It adapts.
It iterates. It cross-references the HTML parser with the information retriever, balancing its tool use to verify its own work before generating a final answer.
Yeah, Claude 3.7 exhibits the foundational requirement for autonomous research, which is reflective reasoning.
Reflective reasoning.
It can recognize a dead end and pivot, But contrast that architectural behavior with OpenAI's GPT-4o mini model.
Oh man, the mini model's logs read like an absolute panic attack.
They do.
It acts like the spam caller. The data shows it averaging nearly 25 tool calls for a single query.
Yeah.
And it's not doing 25 different clever searches. It gets stuck in a loop.
The 25 calls represent a total breakdown in reasoning. When GPT-4o Mini triggers the SEC database search and hits an error, perhaps because it formatted the JSON incorrectly or searched for a non-existent document, it lacks the reflective capacity to analyze why the error occurred.
So it just panics.
Its context window fills up with error codes, and instead of modifying its strategy, its internal weights dictate that it should just resend the exact same flawed search parameter.
Oh no.
It forcefully hits the same wall over and over, consuming compute resources without extracting any new information.
It's the digital equivalent of someone aggressively clicking refresh on a dead web page, hoping the server will magically fix itself.
Exactly.
But even that is better than Llama 4 Maverick, which takes the crown for the most dangerous behavior in a financial context.
No, this one is rough.
It acts as the hallucinator. The logs show Llama completely misunderstanding the fundamental cause and effect relationship of the tool interface.
Yeah, Llama 4's failure is structural. It attempts to use the information retriever tool to pull specific paragraphs from documents it hasn't actually searched for yet.
Wait, really?
Yes. Because LLMs are ultimately probability engines designed to predict the next most likely token, when Llama can't find a document, its language weights take over.
Right.
It simply generates text that looks and sounds exactly like a legitimate SEC filing.
Wait, it just invents a document.
It hallucinates a phantom document directly into its own context window and then meticulously extracts fake data from the fake document.
That is terrifying.
It is grounding its analysis in a reality it just invented.
Think about the RTX Corp case study in the paper, which perfectly isolates how these reasoning failures happen even when the tools work perfectly.
Yeah, that's a great example.
The prompt asks for RTX Core's projected future contractual obligation consumption for the years 2025 through 2029.
Specifically based on their business combinations.
Right. So finding this answer requires digging into a 10K filing, locating a deeply buried forward-looking table, and parsing the columns for specific years.
It's a complex task.
And Claude 3.7 handles it beautifully. It calls the SEC tool, parses the HTML, finds the footnote, extracts the specific years, and outputs the exact correct answer.
Flawlessly.
Then, the researchers gave the exact same prompt to OpenAI's O1 model, which is marketed as their premier reasoning engine.
Yeah, and the logs for O1 on the RTX query are revealing.
What did it do?
Well, the O1 model executes the exact same initial sequence of tool calls as Claude. It successfully pulls up the correct 10K filing.
Okay, good start.
It runs the HTML parser on the correct section. The forward-looking table containing the answer is successfully loaded into its context window.
So it has the information.
It possesses the information, but its attention mechanism fails to synthesize the cross-referenced years correctly.
Wow.
It fundamentally misreads the table and fails the query.
It found the red Lego piece, held it up to the light, and threw it away.
Exactly. Having access to the data doesn't equal possessing the capacity to reason about the data.
Well, here's where it gets really interesting. We've walked through the complex exam, the strict binary grading, and the erratic ways these models use their tools.
Yeah.
Let's look at the actual scorecard. The results of the Finance Agent Benchmark are a brutal reality check for the industry.
They really are.
Out of every model tested, the highest performing AI in the world right now is OpenAI's O3.
Right.
It achieved an accuracy rate of 46.8%.
Less than half of the queries were answered correctly by the most advanced model available.
Wow.
Not a single architecture could break the 50% barrier on a series of tasks that junior human analysts execute every single day.
And the researchers discovered that the 46.8% ceiling isn't just a matter of needing more time, right?
No.
They mapped out a metric called the cost accuracy Pareto curve.
Right, yeah.
They plotted the models on a chart to track the relationship between how much computing power and therefore money is spent on a single query versus how accurate the final answer is. And it is not a linear progression. You don't get 90% accuracy just by spending $10 on compute instead of $1.
The curve demonstrates a sharp logarithmic drop-off.
Okay, what does that mean in layman's terms?
In the lower tiers of compute, spending a few extra pennies per query yields a significant jump in accuracy.
Right.
But the data shows that once you hit approximately $1 of compute cost per question, the models hit an architectural brick wall.
Really? Just at $1.
Yeah. This is a limit on inference time compute. Throwing more processing power and money at the models at this stage yields severely diminishing returns.
Basically, throwing more money at it doesn't make it smarter.
Exactly. You can triple the compute cost, and the model might only gain 1 or 2 percentage points in accuracy.
So you cannot buy your way out of the hallucination problem.
No, you can't.
The underlying reasoning architecture simply maxes out.
Right.
So if the absolute best, most expensive AI model in the world is wrong more than 50% of the time, and you can't fix it by throwing more servers at it, why would any financial institution deploy this? I mean, a system that fails more than half of its tasks seems entirely useless for an industry managing trillions of dollars.
Well, if the objective is to deploy these agents as autonomous decision makers, the benchmark proves they are currently a failure.
Right.
A 46.8% success rate is unacceptable for executing capital trades.
Obviously.
However, the researchers captured a stunning ROI metric regarding efficiency that completely reframes the utility of these models.
Okay, what did they find?
When they timed the human domain experts taking this exact same exam, the human analysts took an average of 16.8 minutes to successfully complete a single complex query.
16.8 minutes.
And factoring in average Wall Street compensation, that human time costs approximately $25.66 per question.
So the human baseline is roughly 17 minutes and $26 per search.
Right. Now look at the performance metrics for the O3 model. It completed the exact same query in 3.1 minutes, and the compute cost was just $3.79.
3 minutes and less than $4.
Yeah.
So the AI operates 5 times faster and is nearly 7 times cheaper.
Exactly. And if we connect this to the bigger picture, it completely shifts the paradigm of how we should integrate this technology.
Right.
The models are not ready to replace the analyst, but they represent a massive leap forward as a first-pass research assistant.
Oh, I see.
Remember the statistic from the beginning? Analysts spend 40% of their week just gathering data.
Right, the Legos.
If a human can offload the preliminary document retrieval, the HTML parsing, and the initial search queries to a system that does it in 3 minutes for $4,
Yeah.
the human's productivity is vastly augmented. The human analyst steps in at the end of the pipeline to verify the data, correct the hallucinations, and execute the final synthesis.
So the AI runs around the house, finds all the scattered Lego pieces, and piles them on the table.
Exactly.
The human is the one who actually reads the instructions and builds this spaceship.
That's the perfect way to look at it.
So what does this all mean for someone listening to this right now?
Right.
Whether you are prepping for a corporate board meeting, conducting your own retail stock analysis, or just trying to summarize a massive folder of PDFs for a project, you have to understand the current reasoning ceiling of AI.
You really do.
You can give these models access to the internet, you can give them specialized tools, and you can give them strict instructions, but you can never skip the verification step.
Never.
The AI is a highly efficient, incredibly fast intern that lacks the capacity for consistent logical synthesis.
Right.
It will occasionally invent facts just to complete the task. Verification is the only safety net.
Acknowledging that structural limitation is essential.
Yeah.
And I want to leave you with a systemic scenario to consider, because technology iterates rapidly and market incentives often prioritize speed over safety. We just detailed empirical proof that the most advanced AI models on the planet currently max out at roughly 46% accuracy when tasked with simply reading and extracting data from historical, public, SEC filings.
Right.
It is effectively an open book test on events that have already happened.
They have all the answers right in front of them and still fail the majority of the time.
Exactly.
Yeah.
So consider the implications for the stability of the global economy if eager financial firms, driven by the desire to drastically cut overhead and secure a millisecond advantage over their competitors, choose to ignore benchmarks like this.
Oh, man.
What happens if, in the pursuit of absolute efficiency, they allow these agentic models to bypass human verification and autonomously execute real-time trades based on those deeply misunderstood documents?
That's a scary thought.
We have already lived through algorithmic flash crashes triggered by simple math errors. We have to ask if our next major market flash crash might be caused by an autonomous AI agent confidently hallucinating the nuances of a quarterly earnings report and executing a massive trade based on a reality that only exists inside its own context window.
Yeah, if you let a machine that fundamentally hallucinates data control a billion-dollar portfolio,
Yeah.
you aren't just losing a few Lego pieces. You are risking the structural integrity of the entire financial market.